Selecting a strike to sell a credit spread really depends on delta. I'm going to be talking about SPY. In option trading, the term delta refers to one of the Greeks, which are a set of risk measures used to assess the sensitivity of an option's price to various factors. So delta really gives us a really good understanding of how this option will behave. Think of it as your chances. That's why when I open up an example, I'm going to show you that the delta that I pick is going to be very low. And that's because a low delta means that there's a low chance of an option being executed. Out of the money will be a low delta, and in the money will be a high delta. The SPY is a very good ETF. It has broad market exposure. So if you check out the sectors that's within the SPY, they have technology, financial services, consumer defense, utilities, and basically everything. Of course, the top 10 holdings are pretty heavily weighted with 30% of their total assets in stocks like Apple, Microsoft, Amazon, Nvidia, and Google, Tesla, Meta, and there's two different class shares of Alphabet. So I want to show you an example of how I would trade SPY options. This is a very popular strategy, and a lot of my students are doing credit spreads. They like credit spreads because when you open up a credit spread, you're only risking a small amount of money, and that small amount of money actually gives you a pretty decent return. In many cases, you can collect 10% per month. Just because you're collecting 10% per month doesn't mean you're going to keep it. That is really, really hard to do. And almost nobody is going to make 10% per month unless they're straight up lying to you. But for me, if I open up a position that has 10% per month, maybe on average, I can keep half. ETFs like SPY are typically highly liquid, which means there are many buyers and sellers in the market. For example, if I open up one of the positions right now, first of all, I'm going to change the expiration date. Let's go out 30 days, okay? 30 days is a very good expiration day for SPY. SPY is basically, the top ETF because, it's the S&P 500. It's the most standard. It's what everyone judges themselves against. So, check it out. If I go to sell and put option, and if I just show you an at the money put, by the way, at the money just means that the current ETF value is 430 and something really, really at the money would be, 430. You can see here that the volume is 2,252. Now, there's so many different expiration days. So there's a lot of liquidity for SPY. I mean, all of these options right here, they have quite a bit of volume. So there's, 1,700. And I bet if I go down to 420, there's going to be a lot, 5,790. And I know that because typically investors are trading very round numbers, so like 420, and I bet you the 410 has more volume than the 415. So like 415 has 1,200, and then the 410 has probably more. Yeah, 2860. Very good volume is important because liquidity means that your cost of trading is lower. So even if you're using a brokerage that is free, and I'm not a brokerage expert, you can figure out the best brokerage for you, but even if you're using a free brokerage, they still have kind of some fees. And what I mean by that is, although you're not getting charged a fee, whenever you're trading, like the difference between the bid-ask spread is a cost that you basically incur. And you incur this cost every time you trade, and especially with spreads, because there's, two different options, you are losing, a couple dollars, multiple times, potentially, 2 times. And if you're opening up 10 contracts, that's kind of a lot of money, right? That's like $20, 2 times 10, 20, right? Okay, so let me show you now what I would do. So for me, honestly, if I go to the charting feature in Yahoo Finance and I just, pull up SPY, this is something that a lot of people really get wrong. They think that you can do technical analysis on an ETF. Well, the fact of the matter is you actually can't do technical analysis on an ETF because an ETF is it's composed of all these stocks. It's composed of 500 stocks, for example. And it's not really moving based on technicals. It's more moving so based on macro factors. And that's why when I was working at a hedge fund, PNC in Philadelphia, back when I was still in college, it was one of my internships for 6 months. One of the quants, and a quant is someone that just analyzes, stocks. He's really good at math. He's really good at technical charting. He's really good at, just like a math genius, I guess. He told me that, stocks typically rise. So the market is typically going up. And that's why one of the things that I don't ever recommend is opening up a call credit spread. Because if you bet against the market, so for example, a call credit spread would look like this. You would say, hey, I think I'm bearish, so what I'm going to do is I'm going to, I don't think the market is going to go up past 435. You would sell a 435 call option, and then you would buy, let's say something higher, so 438. Here, this would be a call credit spread, right? You see that right there. I would not recommend this strategy on the broad market. Since the broad market is typically rising, you don't want to use this strategy since it would be a losing strategy. Since most of the time the market's going up, you would end up losing money. And yes, you can bet on the market going down short term, and that's fine if you're willing to take the risk, but I really wouldn't recommend, taking the risk in doing that. I would prefer to just use put credit spreads, okay? Because, put credit spreads, the benefit of them is even if the market kind of goes sideways, you can still end up making money. So let me show you, and let me show you how delta works, okay? Here's SPY, it's at 430. I'm going to go down, and I'm going to go down quite a bit because I want a low delta. So I'll go to 410. Here, the delta is 0.14. That's actually pretty good. 0.14, again, as I said earlier in this video, delta is kind of like your chances of winning. So here, this doesn't mean that your chances of winning are 14. It's actually the opposite. There's a 14% chance that SPY will be at 410. But if you're doing a put credit spread, that means there is a, the difference. So 100 minus 14 is 86, okay? So you have an 86% chance of winning this trade. So your win rate is 86%, okay? So that's why this option right here is really good because it's out of the money, it's at 410, and essentially there's a 14% chance of this happening, which means there's an 86% chance of this not happening. So what I would do is I would go to sell, put, I would open this position up. First of all, the implied volatility is pretty low, but that's to be expected because this is a very, big diversified ETF. So the implied volatility is not going to be high since it is a, composite of many stocks. So I'm going to go ahead and sell the 410, and then I'm going to go ahead and buy the 405. So if I were to buy the 405, you'll see right now that this is a really interesting position. It's 31 days out, and in 31 days, I would collect roughly 10% of my money. So this is actually almost exactly 10%. It's like 9.9% or something like that. I don't know, something around that, okay? So 45 divided by 455 is gonna be 10% return in 31 days. And I didn't even plan this video because I don't script my videos, and I honestly don't prepare. I just turn on the camera and I'm recording this video now. And like I said, you can make 10% per month in gross collected income. So that's exactly what this is. And you would be winning this about 86% of the time. 86, again, because you're taking the difference of 1 minus the 14 delta, okay? So this is exactly how I would be trading SPY. And specifically, I would be looking to, collect about 10%. I mean, you can also go lower. So for example, let me just show you another example. But here, 10% is amazing, and this is pretty much out of the money by $20, and that's roughly 5%. Okay, so the market would have to pull back 5% in 31 days for you to see a loss. Is that possible? Yes, it's possible, but is it likely? Not that likely. It's probably not going to happen, but it could. It could happen. So that's why you wouldn't want to open up too much of this one position, and you can never really rely on any one position ever, bringing you all of the income that you're looking for. You always want to be diversified and have many positions. I'm going to go ahead and sell the 405 right now, so I'm going to go a little bit lower, and as you can see, the delta is even lower, so it's 11. That means on this position, instead of having a win rate of 86%, you would have a win rate of 89% because, well, the delta is lower, so it's more out of the money. Implied volatility is a little bit higher here. The volume is still good enough to trade. All right, so I'm going to go ahead and sell the 405, and then I'm going to go and buy the 400. So here, because this is safer, now you can see that the max profit is lower. So instead of being $45, it's only $33. So instead of having a 10% return, this is probably closer to a 7% return. So your return has gone down, but also the chances of SPY going down to 405 is obviously less than the chances of SPY going to 410. So this is more out of the money. It's $5 lower. And because of this extra safety, you are getting less premium. So everything is really interesting because in finance and in trading, everything is based on risk and reward. So because the risk here is lower, then the reward is also lower. If the risk is higher, then the max profit would be higher. Okay, and that's actually why one of the biggest misconceptions is win rate. Like, what's your win rate? Oh, how important is it? Well, look, I can actually have a 100% win rate, but I'm gonna have a very, very tiny reward. Like my reward would be, let's say, $2 out of 500, which would be nothing, right? It would be, well, that also wouldn't be too bad, I guess. It'd be 1% per month. But, it wouldn't really be useful if I said I have a 100% win rate and my return is super, super low. Or I could say my win rate is 5%, But let's say I won $15 million and I only lost $10 million in the process. So I made $5 million. Okay, that's why win rate isn't so important. You also just want to pay attention to delta. To delta, it's important, but it's not, that actual number doesn't make the difference between being a profitable trader and not a profitable trader. What the difference is simply the fact that the market's going up, and by selling out of the money options on SPY and using credit spreads, that is a profitable strategy. It's not because I'm opening it up a certain way. It's not because credit spreads are the best strategy in the world. It's simply because the market's rising, and this is an out of the money spread. And an out of the money spread means that it's, farther away from the current price. And because, stocks and ETFs on average rise, or even if they just move, sideways, and if they go a little bit down, this strategy would win. And that's why this is such a good strategy, especially for small portfolios. In fact, if you have a small portfolio, I don't know, if I had $2,000, which is what I started with, and, back when I was like 19 years old, I got my first job on Wall Street. I was working at basically it's like a hedge fund that was trading options, and that's why I became, an option trader, is because that was my first internship and I just stuck to it and I really liked it. When I first started there, I really had no experience. I had no idea what I was doing, but then I quickly realized that option trading is one of those things where, yeah, you can make a lot of money, and some of those traders were pulling in, $15,000 to $25,000 per day. I don't know what their split was, but let's just say they were, they were using other capital, right? Because they were working for a firm. So I don't know, let's say they were pulling in 20%. Well, 20% of $25,000 is still $5,000 a day. I mean, $5,000 a day, 20 trading days, a month, that's still $100,000 per month. I mean, they were doing fantastic. But I also realized that so many people are using options in a safe way to collect premium and to, be safe. And one of the investors that I was working next to, I asked them, options are so risky and there's so much money to be made. He's like, listen, if there's one thing I can teach you, is that option trading is actually safer than stocks. And I looked at him like I had no idea what he was talking about. I was 19 at the time, and I really didn't understand what he meant. But over the past 10 years, I'm 29, my birthday's on Halloween. Over the past 10 years, I just realized that, options can be so much safer than stocks. And if I had $2,000 and I was starting over again from the very beginning, that was my first paycheck. I think I may have gotten $2,000. I was getting paid $20 an hour when I was 19, which was, quite a bit of money. That was 10 years ago, so that was not bad. I was really happy with it. What I ended up doing was I ended up putting it all into the market, and actually my experience wasn't all that good because I didn't know what I was doing. So I was following big name investors. At the time, it was Carl Icahn. Now it's like Cathie Wood and, other people, right? Other famous Michael Burrys and other YouTubers are making all these videos about all these guys. But in all honesty, it doesn't really matter. You shouldn't really follow anyone else. You should learn how to trade yourself. You should learn how to invest yourself. And you should fire your financial advisor if you have one. You should just be managing your own wealth and put it into your own hands, because no one's going to take care of your money like you can. And that's exactly why I have this YouTube channel. So if you subscribe and I really appreciate that. And you can always check out my Discord community in the first link in the description.